Hello, everyone. Welcome to the Final Bar. Today on the show, we hit the market from three directions as we do every Monday. The top-down macro to give us the big picture perspective, the sector rotation level to understand how assets are rotating around the 11 S&P sectors, and then the bottom-up perspective looking at stock picking and particular patterns that have emerged. You know, from my review looking at the stocks and then looking at what we're seeing today, market sort of flat to up a little bit. A lot of the long-term charts sort of leaning lower, but today we have a bit of resiliency. So how do things look from these three perspectives? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of the markets from a technical, behavioral perspective. Pay attention to the short-term fluctuations, but most importantly, connect them to the long-term trends. We've talked last week, we talked in particular about, mindful investing, and I've often talked to clients and investors about the way that they consume information, in particular the order that they go about things, and focusing on a proper long-term perspective if you're a long-term investor is really, really important, because it's so easy, especially in this environment with a lot of volatility, a lot of fluctuations. It's very easy to get caught up in the flickering ticks and the short-term movements, the news headlines, the latest sort of clickbaity announcement. All is going to draw you into a very short-term point of view. We want to focus on the long term. And so, I think as the trend evolves, as we're in this period of indecision of sorts, I think it's really important to pay attention to the most important signals. At what point do you really feel you need to take action? Hopefully we'll be able to help you determine some of those signals, some of those levels in our time here today. We have a lot of great guests coming up this week and next week on StockCharts TV to help make sense of what we're all seeing. Tomorrow on the show, Sam Burns from Mill Street Research. On Wednesday, Chris Brecher from Brecher Trading. On Thursday, Joe Duarte from Joe Duarte and themoneyoptions.com. Earlier today, we actually premiered our latest episode of Behind the Charts, so check that out if you missed it. All of our shows are replayed on our YouTube channel, so you can catch up on anything that you might have missed. Tony Hansen joined us not too long ago at a money show, and we had a great conversation with her about just how she approaches things. It's a very visual form of analysis and a very simplistic way of thinking about price patterns. So if you use price patterns, or if you never have and you're trying to just understand how it fits into the toolkit, she did a great job of just explaining how it fits into her methodology. Also, as a reminder, the week of July 13th is going to be really cool here on StockCharts TV. We're planning a wonderful week of guest presenters, all of our StockCharts contributors, special panel at the end of the week, all focusing on a market outlook for the second half of 2020. You're not going to want to miss it. A lot of good ideas are going to come out of that week of July 13th. Let's recap the week recap the day, going into the market recap here. So the S&P finished up about 2/3%, closing just above 3118. So again, as we're going to look on the long-term trend, I don't think this changes anything a ton. This is sort of, some buying coming in out of the open, buying going into the close. That's all overall net positive, but it wasn't a dramatic move. This was still, well within the range from Friday. Really didn't deviate from where we were. We closed pretty close to where we were, up a little bit, but still the second half of Friday and today's range were pretty much identical. So it was a non-movement sort of day is how I would describe it. Small caps up a little bit more, but not dramatically more, and mid caps up a little less. So there have been days when small and mid caps have been really leading the way. So the S&P up a little bit, but small caps up a ton. That wasn't really the case here. It was sort of everything drifting higher through the course of the trading day. Technology in the number one sector, which should not be a huge surprise if you've been watching the show. We've been focusing on that tech domination theme for quite a while, but the NASDAQ 100 finishing up 1.2%. And the rally today pushed the VIX back down just below 32. Let's look at some other asset classes, then we'll start looking at some of the charts together. So 10-year yields to 70 basis points, up a little bit. The TLT actually sort of flat, finishing pretty much right where it right where it closed on Friday. Opened up a little higher. Looked like it was going to be a rotation into bonds today, but they sort of finished flat for the day. Oil up pretty good. Energy up 0.5%. So not a huge update for energy, but the USO certainly up significantly, over 2.5%. Gold as well actually jumped up pretty well out of the open, sort of drifted sideways through the remainder of the day, but up another 0.6% from Friday's close. Let's look at a daily chart of the S&P. So as we've talked about on Friday's our Wrap the Week segment, which was just a fun opportunity to take a step back looking at all of the themes that we follow as part of our Mindful Investor Live chart list. And what we sort of keyed in on was this stabilization within the equity markets. We're now sort of range bound. We had the big spike up to just below 32.50, around 32.35.40. Then on the downside, we pulled back, and Thursday, a week and a half ago, was a significant down move. We had a couple lower lows, took us down to around 29.70, 29.60 or so. Then since then, last week was really sort of a sideways fade. This was really a digestion. Really, you take the peak from a couple weeks ago, the low from a couple weeks ago, and we're almost 50% of the way right down the middle in that range. That's what we've talked about, sort of this consolidative move within the equity phase. So even though we traded up a little bit, this is still within the range of each of the last 4 trading sessions. It wasn't a dramatic move. We're really just holding our ground right in the middle of this. So, from my perspective, we can go sideways for plenty of time, but at some point, either buyers take control and push us above 32.50, sellers take control, push us below 29.50. And again, when I say buyers or sellers take control, that's just a shorthand talking about, an excess of supply or demand that'll cause the market to move significantly away from an equilibrium. Right now, basically, investors are saying we have sort of a fair price for where stocks should be based on all known information. And at some point, something tips the scales one way or the other. So that gives us a pretty broad range. And at this point, I feel like it's sort of it's a hold rating of sorts, right? You're sort of in the middle of this trend overall. If you look at the long-term model that I follow, basically all 3 of these are positive now. The long-term model positive based on the weekly moving averages, medium-term positive, short-term positive. So all those timeframes are sort of net positive, which makes sense. We've got this pattern of higher highs and higher lows. The reason why I'm just sort of neutral and not saying I think we're going to go to 3,400 is because now we're in this equilibrium range. And I think if this resolves lower, I think you have to then admit that we've had a lower peak and a lower low. So 31.50 is certainly the short-term level I'd be looking for this week. And if we remain below there, that sort of continues to establish this lower peak that we've seen, and a break to new lows around 29.50 would sort of cement further downside. But until then, I'm not seeing it. Also worth noting on the daily chart here, and I'm taking a little more time on the macro because I know we have time for sectors and stocks later in the show today. I was noting on my weekend review how the S&P, the RSI has remained above 50 really since the second week in April, right? So out of the lows in March, you had a couple weeks coming out of the lows. The RSI broke above 50 second week in April, and it's remained above 50. And each one of these pullbacks, the RSI has tested 50. That's actually kind of unusual. In a normal sort of fluctuating market, a bull market phase remains above 40, but you'll have pullbacks back to there. You can see the whole thing sort of elevated, which tells me that as long as the RSI remains above 50, sort of feels like this consistent trend is going. If and when we break down below that, that would be another sort of potential indication that things are going to rotate a little bit here. On the sector basis, we're going to talk about sectors later, but just in terms of today's recap, technologies closed almost 2% higher, followed by consumer discretionary, followed by utilities. This is a great reminder to not think of a market outcome and then decide what sectors to be in. Remember, something like utilities, which you'd think of as defensive, can be going up. It outperformed the market today, and with a decent dividend component as well. On the downside, financials, the big loser today. We're going to look later at Morgan Stanley. This when we talked last week about a couple stocks to follow to get a good read on the overall environment. Morgan Stanley in the financial sector was one that we highlighted. So we'll take a look at how that chart has evolved over the last week or so. We don't have time to get into some of the industry notes, but I just would point out the influx of technology, a consistent sort of bellwether here in the top 10 of industry groups, and 2 of them, computer hardware and software. And Apple obviously has the developers conference happening today with usually some fascinating announcements about what they're going to try to do to diversify from the iPhone and so forth coming out for us. Also worth noting, though, gold miners at the top here, and that group with Newmont Mining and the other gold miners had been falling off for a little bit, actually coming back a little bit with gold rallying pretty nicely. The chart holding up very well. I don't see Newmont Mining in the top 10 of our scooter rankings anymore, but the group overall holding up just fine today. Let's move on to our next segment called Sector Setups. So what we love to do on Mondays, now that we've talked about sort of the big picture environment, let's look at some sector themes and see what we can see about the sector rotation. We always start with the RRG, the relative rotation graph. Julius DeKempener, one of our fellow contributors, does such a great job. He created this visualization. Just check out his show, Sector Spotlight, if you're looking for a better understanding of how to use this. But essentially, you have the 11 S&P sectors rotating around the benchmark, the S&P 500 right there in the middle. I've used this as a visualization for years, and I tend to look at the weekly view just for a big picture sort of sector perspective. What's working, what isn't, how are things changing? And the themes have not changed a ton since last Monday. If you followed the show for a while, I would say the only things that have continued to evolve is this rotation. You know, on the strong side, you have technology that has just teased the weakening quadrant, but just keeps rotating to the northeast, and overall has been the strongest sector, continues to be that way. Communication services, consumer discretionary would be number 2 and 3, looking at the relative strength. And again, very simply, further to the right means relative outperformance, further to the left, relative underperformance. And the rotation, the vertical axis and so forth, tells you a little bit more about the momentum behind that, sort of the rate of change of that relative point of view. So you can see here, I think the second part are looking at things that had been strong that are really weakening, and healthcare is certainly the most obvious candidate for that. It's fascinating. We're going to look at Merck a little bit later. It's amazing how some of those big healthcare names, and not just in pharma, but elsewhere, had been really strong charts that are now just, rotating away. And while something like tech, something like Microsoft, just continuing to go up and to the right, long and strong, a lot of those healthcare names have really been challenged. There are some pockets within there that look pretty good, particularly in biotechs, but overall the sector has been struggling. The third group of the things that are really struggling, and that's consumer staples, utilities, real estate. It's interesting, staples are down here. We're going to look here in a minute at the ratio of consumer discretionary versus consumer staples. Even though consumer discretionary overall long-term very strong, consumer staples long-term very weak. In the last 6 to 8 weeks, you've actually seen a bit of a rotation. So on the daily RRG, you'll see a bit of a different picture where consumer staples have actually improved a little bit. Consumer discretionary has started to weaken. So we're going to look at those charts here in a minute to get a little more clarity. Then you get the improving groups, and all 3 of these sectors now in the improving quadrant: industrials, financials, energy. Interesting to see financials here finally in the improving quadrant again. And again, heading northeast is sort of the direction of positive trend. Heading southwest is sort of the direction of negative evolution. So, certainly your rotation away from healthcare staples, utes, into industrials, financials, energy. A lot of these are the groups like airlines, like banks, that had been absolutely brutal and have come back and whipped around very quickly. Again, on the daily RRG, you'll see a bit more of a rotation back to the downside because things like airlines, American Airlines is one of the biggest losers in our scooter rankings today. So we'll see how some of those charts have evolved for a little bit. Let's look at the candle glance page. So after looking at the relative rotation graph, I like to look here and just see what sort of themes I can come up with. And if you glance around, the quiz question is, how many sectors are above their highs from February? And if you look for a second, you will see the answer. And the short answer is one of them actually remains above their high, and that's technology here. One of them had broken above their 2020 high, but now back below, and that's consumer discretionary. So really testing that resistance up at the top here. If you look at the chart of technology, again, the relative strength continues to just be impressive. It's had this huge V bottom, a pullback, and now a close once again above the previous high. It's threatening another 52-week high, not quite making, or maybe just rounding error-wise, right at the level from a couple weeks ago. But the real impressive part is the green arrow here at the bottom. Since the December 2018 market low, just owning technology and going to the beach somewhere would have given you a 27, 28% relative gain on the S&P, just for having excessive exposure to the technology sector, and that speaks to the dominance. And that is not just a quick turn like you've seen from energy, where it had been struggling and then just continues to come back very quickly. This is sort of slow and steady outperformance. This tells you why being over allocated, or being, having a healthy allocation to technology has certainly been the right call. I think that remains the right call, because in stretches in the last year when the market has pulled back a little bit, technology is actually holding up really well as a safe haven with these mega cap tech names that have done very, very well. So overall, it just continues to be a really good place to be, I think, and to consider if you're not there now. Consumer discretionary is an interesting chart only because it's like tech. If it hasn't broken out yet, it's sort of earlier on in the tech breakout story. Consumer discretionary really got hit into the March lows, but really dramatically turned around. This is when it looked like staples were going to go to the moon, and stocks like Campbell's and General Mills were looking so strong. But that relative strength picture changed dramatically after March 23rd. And you can see how consumer discretionary back flat for the last 12 months, up a little bit. So think as consumer discretionary over this period here from around here, up 28%. And consumer discretionary essentially flat, up a couple percent from the December 18 market low. But this shows you how much of an outperformer tech has been relative to other sectors. While we're looking, we talked about financials very briefly. A couple of these sectors have failed at their 200-day moving average. And again, broadly speaking, this is what concerns me. And again, I try not to be perma-bearish and think of always looking for downside. But again, I learned this toolkit in the year 2000, and I learned it in the early 2000s, and I learned about technical analysis as risk management. So I think I'm just programmed to be looking for potential weak spots when I'm seeing the market in a decent position, which is what it's in. I'm concerned about the outperformance of tech and how that has driven the indexes higher. When I look at something like the financial sector, I don't feel that great about the overall market environment. If this was the market, I'd say this is actually kind of scary, or a little negative, because you failed at the 200-day. You rallied, you've now established a lower high. You're potentially doing a lower low, and that 2250 level right around the 50-day would be a really key breakdown. It has not done it yet, but I'm concerned. I'm concerned on that one. Utilities as well did pretty well today, but overall, that's another sector that's failed at previous support, failed at the 200-day moving average. So even though tech has done well, even though consumer discretionary holding up well, even though communication services holding up well, if you look at any of the other sectors, I think you find some potential issues with lower highs, struggling at moving averages, struggling at resistance. That's not the sign of a healthy overall market. That's a sign that if you're a good stock picker or a good allocator within sectors, there are places that you can outperform. That might be a great signal for you if you're thinking more about how to rotate within an equity allocation. But certainly for the broad environment, I think it raises some potential concerns there. We need to take a quick commercial break. That's our sector setups for today. And we're going to come back with the segment Shifting Stocks, focusing on individual names and how they've changed. We'll see you back here in a minute. Hey everyone, welcome back to the show. This is Dave Keller at StockCharts.com. As a reminder, we love to hear from you, answer your questions, and we have a segment called the Final Bar Mailbag, which we do twice a week. We'll do one again tomorrow on the show. So if you have any questions on particular charts, technical indicators, settings, StockCharts.com, how to use it, behavioral finance, decision-making, market structure, nothing is out of bounds. I can't guarantee I will know the answer, but we have some fantastic guests coming on that can help me answer things I don't know. Just shoot us an email, thefinalbar@stockcharts.com. We gather all those questions. We'll answer some of them in our mailbag segment tomorrow. Our final segment for today, we've talked about the big picture macro. We've talked about sector rotation. Now we're going to hit on individual stocks. And as I've told you in previous weeks, part of my routine every weekend is to go through the S&P 500 a stock by stock basis. I've done that for a number of years, and I learned from some of my analysts at Fidelity that it's just such a great exercise, just a great way to stay on top of themes. And I found very quickly that themes would emerge on individual charts, before they would emerge on the broad index. And that's because of how indexes are weighted. So for example, now the broad indexes are weighted very much toward technology, consumer communication services, which means sometimes you'll find some problems under the hood by looking at breadth and by looking at individual charts. So let's look at a bunch of them. I'll try to get to as many as I can and hit on some key themes. We'll start in the technology space. Last week, as I mentioned, we talked about a couple key charts to pay attention to. Applied Materials was one of those, and the semiconductor space usually is a good bellwether for the overall market. So this as a group tends to do well in bull market phases. So just looking at the relative performance of semiconductors can, for the most part, give you a good sense of whether the market is in a healthy configuration. Applied Materials is one of those stocks in that group. The group overall has done very well. Relative strength going to new 12-month highs in the last week or two. Applied Materials not quite there, but very, very close to making a new 12-month high. What's impressive about this chart and why it's an important one to watch is we broke above the 200-day moving average in the last month, pulled back and retested the 200-day moving average from above. That was a week and a half ago. Now we've broken to new swing highs, and on over the weekend, I'm looking at a new swing high there, but we sort of closed lower from the open. So I was curious how things are going to follow. As long as a stock like this remains above its 200-day at this point, that's overall pretty in a pretty decent position. And so far today, rallying just fine. So recovering from a bit of a pullback on Friday going into the close. So overall, this is in a pretty constructive position, not overextended. So in terms of leaning into a stock like this, it makes pretty good sense. And you've got upside at least to the previous high, unless the trend continues. But overall, I'm seeing no sign of trend reversal there. It's sort of long and strong, and the 200-day would be a good sort of potential downside risk to pay attention to. Cisco, another name obviously within technology as well. This one is a little bit more concerning, right? While Applied Materials had broken above, retested, and now breaking to new swing highs, you can see Cisco has failed to do that. So broke above the 200-day, tested it from above, made a lower high, and now back down to the 200-day. So, when I was looking at the S&P charts, I look at Applied Materials, I feel pretty good about the world. I look at something like Cisco, and again, don't get me wrong, it's not horrible. It's just not great, right? It's sort of a stock that's potentially putting in a lower high. The next step would be breaking below the 200-day, breaking below the swing low around 43.50. That might coincide with an RSI around 40. And so if that sort of stock breaks down through those sort of support levels, that would be concerning to me. So that's why I'm sort of paying attention to this chart right now. I'm going to go through just a bunch of other random charts that have come up. I noticed this one, and I've had things like this where people ask if this is a head and shoulders top. So, the short answer is no, you can't classify this as a head and shoulders top, because if you actually read the literature, something like the Edwards and McGee book written in, well, it was probably like the 1940s-ish, 50s. I forget when that book was read, but sort of mid 1900s. The head and shoulders pattern is really designed to be a longer term pattern, like a multi-month pattern, 3 to 6 months type of thing. This to me is more just establishing a lower high. And again, the interpretation is the same, because this is an uptrend of higher highs and higher lows. You've now made a lower low, a lower high. And if we break below that swing low, that becomes sort of a little more negative. So, Disney had come up and tested its 200-day moving average, rolling over. The relative strength has been suspect for the last 6 weeks. So overall, sort of feels like an avoid type of name relative to some of the other things that we've been looking at. Now within technology, sorry to jump around, but I'm going through my random notes as I was looking through charts in here. I think within technology, charts like Microsoft, Apple. Microsoft's made a new 52-week high on a closing basis, as well as relative strength. Apple, again, with the developers conference today, up 2.6%, new closing high, new relative strength. So, there's no problem with big cap tech. Again, this is why the S&P overall, I think, is holding up pretty well. That's how you can counterbalance stocks like Cisco and Disney being a little weaker, because stocks like this, the huge, largest cap stocks, are holding up very, very well. So don't get me wrong, there's some really good charts within that space. Let's continue. Within consumer, you also have Nike. Nike's an interesting one because it's testing its 52-week high. It's around 105. And it set a high in January. A lot of stocks did, even though the market topped out in February. So the top was here. We retested it almost to the penny here early June. It's the first week in June. Now we've pulled back a little bit. And the question is, do we retest the peak and break out, and this is sort of a cup and handle like bottoming pattern, or is this the further downside? And right now you're sort of in that range. You're sort of in that 105 on the upside, 92 on the downside, which would be breaking through the swing low, breaking through the 200-day moving average. So, again, I think the market's sort of range bound as a whole. I think Nike's a good example of that, and I think seeing which way that sort of breaks could be really interesting. Continuing our random look through charts, airlines had been pretty impressive coming, American Airlines coming from below $9 to above $22 in the span of about 3 to 4 weeks. That's a pretty huge rotation, but I think it's worth noting these stocks have traded pretty heavy since testing the 200-day here on American Airlines. Pulled in now a higher low, but now a lower high. We're now testing that low. A break below 14 would suggest weakness, but it's down almost 7% on a day when the market was actually up a little bit. So overall, that feels weaker rather than stronger. I think it's something you'd probably want to hold off on until you get some sort of confirmation, some sort of stabilization. I mentioned the weakness within healthcare, and Merck is maybe a good example of that within big pharma and maybe some of the challenges there. If you look, these stocks actually did really well coming out of the March low. So the first week and a half was actually a little stronger, but then look at the relative strength for the 8+ weeks, 8 to 10 weeks after that rally. So from the first week in April to where we're at now, it's just been a consistent relative underperformer. And you can see that the price has never really gotten above its 200-day. Every time it has, it's quickly reversed and gone back low. Just last week and a half, we made a new swing low. We've now bounced up a little bit. So, all else being equal, this is a pattern that tends to continue downwards. You have a lower high, a potential lower low. So overall finish, feeling weaker rather than stronger, with the relative strength so negative as well. So, within healthcare, there are some pockets of opportunity, but big pharma certainly doesn't appear to be where that's at. Just to wrap up here, maybe 2 more quick charts. Walmart is actually a really interesting one. Talk about staples and how in the last couple of weeks we've seen outperformance from staples. Walmart might be a really good example of this. This is a stock that a lot of people wrote off. Relative strength has been dismal. It's pulled back to an ascending 200-day moving average. Going into today, I'm thinking, boy, if we get a bounce off the 200-day, this actually could be kind of interesting. Up 1.5% when the S&P was up about a third of that. So overall, sort of potentially bouncing off the 200-day might be an interesting sort of bottom fishing candidate of sorts, sort of expecting to get a bit of a bounce off of the lows. And then finally, I can't remember if I even showed this yet, but I just wanted to remind you, Morgan Stanley is one of the other couple charts we mentioned last week is an interesting one to watch. Overall, this feels less positive than other names, and I think the 200-day, that 44 level, would certainly confirm more of a rotation to the downside. But overall, in a holding pattern. So, to summarize my look at individual stocks, I think you could see it. The names look fantastic, and it's the big cap tech communication services name. Microsoft, Apple are good examples of that. You have stocks that look relatively weak. Things like Merck are maybe a good example of that. But the average stock looks kind of like this. It's Nike, it's Morgan Stanley. It's sort of in that holding pattern. And the question is, where does it go next? We need to wrap the show, folks, and go right to the 3 and 3, though. So here we go. Chart number 1 is looking at the S&P 500. I mentioned this in our the beginning of the show. I think that RSI 50 level is going to help us. I'm looking for whatever I can to try and identify if and when we're going to rotate lower. And I think that's one thing I'll be looking at here at this point. We're still in wait and see mode for the S&P 500. Chart number 2, where we're not in wait and see mode, though, is the McClellan oscillator, which has rotated back below 0. This has been sort of volatile. It's been right around that zero level. In general, when this is above 0, more bullish breadth. If it's below 0, more bearish breadth. It's been chopping right around that 0 level, but at this point, more on the downside. And all it tells you is that the average distribution over this last couple of weeks is sort of outweighing the average accumulation, and that's why it's more below 0. So if and when this remains below 0, that would tell you something about negative breadth at this point, sort of in the middle. Last chart I will show you for the 3 and 3 is the percent of stocks above their 200-day. We usually look at this for the S&P 500. It's just below 42%, not updated for today. So we'll see how today actually adjusts this. We usually look at something else. Here we're actually looking at the New York Stock Exchange. I think it's worth noting that 42% of the S&P above their 200-day moving average, but less than 30% of the New York Stock Exchange. This shows you that it's the large mega cap names that are really driving that outperformance and that positive breadth. The average stock, a little weaker rather than stronger. That's our show for today, folks. I want to thank you so much for joining us. We have great guests coming up the rest of this week, so don't forget to tune in every weekday, 6 p.m. If you have any questions for us, just shoot them to us via email, thefinalbar@stockcharts.com, or tag us in a comment on Twitter @finalbarsctv. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.